that the Fed is tightening more aggressively. There is all these dollar-denominated debts throughout the world that basically represents demand for dollars. But there are major periods in history where you get a huge spike in the dollar and then you get a huge fall in the dollar. So with the U.S. dollar situation, one of the biggest weaknesses that the U.S. has had relative to the rest of the developed world is that we run these bigger trade deficits, which are normally bad for a currency. And so whenever we're like more dovish compared to the rest of the world, or just as dovish, you have a tendency for the dollar to start falling. And so if we do reach a pivot point where the Fed is unable to keep tightening, you could get a pretty notable fall in the dollar. Now, because the United States is more energy independent, or at least less energy vulnerable than what we've seen in Europe and to some extent Japan, that keeps our basically the trade deficits of Japan and Europe got worse, whereas the U.S. is still bad. And so that kind of makes that comparison harder. Whereas in pre-energy crisis markets, you would have had a trade surplus in Japan, a trade surplus in Europe. And so if the Fed loosens, gets more dovish, you'd have a fall in the dollar. Now it's a little bit less certain because you have such a crisis of energy in those regions. But I do think that at some point the dollar could stop going up relative to some of those other currencies, because they'll reach a point where they're kind of at max tightness. So I would be concerned about kind of pivoting too hard into the dollar at what could end up being a local top. But I do think in general, currency diversification is a good thing.
As the Fed essentially bought themselves a little bit of leeway then to actually print.
Well, so it's funny. We're starting to see, the United Nations of all places called on the Fed and other central banks to stop tightening. They could cite financial instability as a reason. There's things that they can do, or that the Treasury can do, in order to stop the dollar from going up. But they generally have bad optics when official CPI in the United States is 8%, and Powell's trying to do his best impersonation of Volcker, where he's trying to phrase it like willing to sacrifice almost everything else in order to get inflation back down to the target. And I think it's either going to fail or it's going to be short-lived, right? Because I think I've described it like holding a beach ball underwater. As long as we have these energy shortages throughout the world, then whenever they're not kind of aggressively holding down demand, that inflation is ready to reemerge. And so basically I think that this is going to be an ongoing cyclical problem until you get more of a supply response. So normally when you have high energy prices, you get a lot of new supply coming online, but that takes time. The markets are, because it's so volatile, markets aren't sure what energy prices are going to look like in 5 years, for example. So they don't want to bring on these long duration billion-dollar projects. And then two, we've seen basically just because of the ESG environment and because of things like windfall taxes and just there's a lot of lack of clarity now about forward policy around these energy sources. And I think basically public opinion and political opinion has to kind of change on that in order to kind of get past this crisis. Then they can revisit whatever they want to do. But I think that right now, policy is kind of getting in the way of some of this energy supply. And also some of it's just, private pools of capital. They're saying, hey, we're going to divest from fossil fuel companies, we're going to divest from this. And so fossil fuel companies like oil companies and gas companies, they're being cash flow positive. So they're basically being very disciplined and very careful with how they manage their capital. They're saying, okay, we're going to be profitable. We're only going to, we're not going to over drill. We don't want to make the mistake of like bringing out a lot of new supply right at the top of the market. And so they're playing it very cautiously, and that's kind of feeding into this supply limitation. Also, you have OPEC is purposely contributing to it. And so it's kind of a toxic combo that's not going to resolve itself until more energy supply comes online and is encouraged to come online, and then is able to also get to market. So it's not just the production, it's also the infrastructure, the transportation infrastructure, LNG capacity, things like that.
Did you see that the CEO of Shell came out recently and said that energy companies should be taxed more?
I heard something along those lines, but I haven't read into it too deeply.
Yeah, it kind of blew my mind. Okay, so last thing I just want to ask you about, Luke Woman put out a tweet, and you might have seen it. He said, in central bank circles, it's well known that world debt markets, as we know them, can only be maintained with cheap and cheaper oil, Without cheap oil, the entire system fails and reverts back to pay-as-you-go economies. Okay, I didn't understand it, but I felt like it's something it would be helpful to understand. And do you agree with him?
So I do agree with him. He's a great analyst, and there's a couple ways to describe it. One is that basically economies flourish when energy is cheap and abundant, right? And so that that necessary input cost becomes a much smaller percentage of our disposable income, of business expenses, of all sorts of things, and that allows other things to grow better. And it also allows for less inflation and therefore lower interest rates. And when you do a calculation on, say, a stock valuation, you're generally comparing it to like a long duration bond. You're saying I could own a 10-year treasury. What would it take me to own this stock instead? And so if the 10-year treasury is 1%, the hurdle for owning that equity is a lot lower, meaning that you're willing to pay a lot more than if the 10-year treasury is 4%. Then you're not willing to pay as much for that equity. And so the problem is if you have a significant repricing in bond yields due to energy shortages and higher energy prices and higher inflation that comes with it, basically stock valuations are going to come down. And then the problem is that because systems are so financialized, for example, in the United States, we have our stock market got up to 200% the size of GDP. And if you graph tax receipts compared to the stock market, there are very similar charts. Tax receipts stop going up and start going down even if the U.S. stock market rolls over. It's kind of like the tail wagging the dog, and that's if you include property prices. I mean, different countries have different bubbles, right? So sometimes it's their property market, sometimes it's their stock market, sometimes it's a little bit of both. But generally, most developed countries are so they had such low interest rates and such high valuations of many of their assets. And that's really not sustainable in a world of higher energy costs. And then you have more acute problems like, if energy gets out of hand, then you have Europe start shutting down like aluminum, refining and other types of energy intensive manufacturing. And then therefore you have just less economic activity, that's less tax revenue. You already have high deficits and high debts. All right. So now you have more sovereign bond supply coming to market because you're filling that deficit gap. And so that's when you start to enter this kind of out of control inflation scenario where central banks have to print in order to support their sovereign bond markets, despite the fact that inflation is above their targets. And so they encountered that in the 1940s, due to populism and then due to war. And now they're encountering it due to, energy crises, high debts, populism, and this time it's also because of how aged the West is, right? So a lot of our entitlement systems are stressed by the fact that there's a much higher share of people that are receiving benefits, relative to the size of the population compared to what it looked like 20, 30, 40, 50 years ago. And so a lot of these things just aren't solvable in a workable time horizon. And so I think it essentially ends with money printer go burr.